day, everyone. Thank you for joining us once again here at Seafried and Brew for our weekly webcast. For this week's webcast, we're going to be looking at the results of the second quarter 2017 for our stock bank benchmark group. So when we look at our performance risk report, the base benchmark we look at are those banks with assets between 100 million and 5 billion that are stock banks. We exclude the subchapter S institutions out of that group. So our base group is this benchmark stock banks here. And as you can see, the return on average assets for the second quarter 2017 up slightly. We're up 6 basis points, going from 83 basis points up to 89 basis points. And when we walk through some of the metrics here, we'll find that this increase was led by the net interest margin here. We saw a similar increase in the average return on average equity, moving up to that 8.13% in here, beating the past 4 quarters in here, looking back to the second quarter 2016. The 831, the prior top was at a 792 back here in the third quarter of 2016. So we're looking good on the earnings side. Seems like we're on an upward swing. The past 2 quarters we had a decline here. Now we're back on the upward swing for this stock benchmark group. Looking at net interest margin, we saw an increase here up to that 3.78, increasing 8 basis points in that net interest margin. This is a big positive because, as you can see, we were on a downward trend for the past 2 quarters. The question is this an anomaly, or is this quarter going to be reflected in the next couple of quarters and continuing to see this increase in net interest margin? That is what we're hoping with the stabilization of the shorter end of the curve as well as that longer end of the curve. So hopefully we will see this trend continue into the third and fourth quarters of 2017. Looking at the dynamics between the cost of funds and the yield on earning assets, you can see here cost of funds at 0.5%, 50 basis points, up just 3 basis points from last quarter at 0.47. Now this is the total cost of funds, so this includes both the cost of deposits as well as the cost of borrowings in here. When we look at the yield on earning assets, we saw an increase of 11 basis points, so we're up to that 4.16. That led a little bit by that increase in the longer end of the yield curve, but also in here, this could be a reflection of the increase in the overall loan portfolio as a percent of assets. So we've seen that trend kind of continue throughout the past couple of years, and this is being supportive of that higher yield on earning assets. When we look at the cash type deposits to total deposits, and if you recall, the cash type deposits are those non-maturity deposits. So you're looking at your DDAs, your NOWs, your savings, and your MMDAs. Over the past several years, we've seen a continual uptick in this ratio. This is the first quarter where we're starting to see this level off. In fact, it came down just 9 basis points from that 70-89 to that 70-80 here. So we've come down a little bit, but the stabilization we've seen at some banks, the need to do those CD specials in order to retain some of those customers. We're going to keep an eye on this. This is an important ratio. If we continue to see this stabilize or even come down, that's going to be an indication that the tolerance or the appetite of your customers could be leaning more toward those longer term products. Or they're just pushing their monies out of their lower cost or lower interest rate demand deposits and money markets and savings into these CDs. So this potentially could have a reverse effect on that rising net interest margin if we start to see more and more depositors go out on the yield curve a little bit and start to hit that CD market, increasing your overall cost of deposits and then therefore increasing your cost of funds. So we're going to keep an eye on this trend. This is a very interesting trend that we're looking at here. However, when we look at the net overhead, if you recall, this is the difference between non-interest income and non-interest expense. We're down to 2.08. We've been on this downward trajectory here. What we like to see banks is around that 2% mark, high performing or top 15 percentile, more likely around that 1.75. But a 2% is basically where we like to see institutions. So the benchmark is starting to get back down there. Effective tax burden here, we're at that 30.45% for that tax rate on average, around that 30%. So that's the average. What we like to say is that if you're real tax efficient, you're going to have a tax rate of somewhere between 20 and 25%. So we like to see our banks, the smaller institutions primarily, work in real close to their AMT. But overall, on average, we're at that 30%. We could see banks making up some headway here, getting back down to that 25% by the end of the year. When we look at the balance sheet here for the second quarter with these last 12-month growth rates, assets up almost 8% at that 7.89% asset growth rate. Loans leading the way at 9.78. And therefore, with the loans being greater than assets, you see that loans to asset ratio continue to increase in here. Deposits up 8.29% over the last 12 months. When we look at that loans to deposit ratio, again, we continue to see that move up. Came down slightly last quarter, picked back up. We're at that 68% overall for the national benchmark. And continually see this happen where we're getting the loan portfolio building as a percent of assets, supporting that rise in net interest margin and yield on earning assets, but also potentially increasing that future credit risk in the bank overall. Non-current loans, one of the staple credit risk indicators on a national basis, has continued to come down at that 0.93% in here to total loans. So we continue to see this come down. That's a big positive that we continue to see that. Overall, when we look at our risk index, our total risk index, recall on a quarterly basis, we look at institutions' risk on 4 categories: the earnings at risk, liquidity risk, capital risk, and credit risk. And this is our index that compiles all those risks together. And overall, for the benchmark group here, you can see risk came down just a little bit from where we were last quarter in the last year. In the second quarter 2016, just a slight reduction in that risk overall. We're still in that moderate to low level of risk. We like to see banks in this area kind of down here. This tends to be where we see banks get their biggest bang for their buck in their total return, or their risk-adjusted return is when we see them in this area. That's what we have for you this week. Next week, we'll look at a couple of economic statistics that have come out and look at some projections as far as rates, both on the short end with the Fed as well as the long end with the 10-year going out for the next couple of quarters. Have a great week.